So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions.
I mean, think about like if you're a real estate professional, you might buy a single family residence, you might buy a duplex, you might buy a fourplex, you might buy a small apartment complex. With solar, you may buy movable units. You might buy, say, pods that the roof of those pods are solar panels. And those pods basically compete with, Pack Rat and Pods, the business. But the pod that you own produces energy and actually provides a movable space for people to move their stuff from house to house. Or you might own panels on the roof of a storage facility or a hospital or a airport. So essentially you're gonna own energy producing panels somewhere, whether they're carports, they're integrated into cool movable products, they're on top of hospitals. That's your business.
Okay, and then your experience is people are making what kind of cash on cash return on that million that they invested?
Well, the way that we generally structure it is if they're putting $1 million in of cash, let's just say they take no financing.
Yeah.
They'll have $500,000, get $500,000 back in tax credit.
Yeah.
And they'll have a $750,000 depreciation that they can take in the very first year.
Okay.
Federal. So depending on their tax bracket, let's just say that saves them 40%. So they have $300,000, right? So they're almost in the black on the tax savings. And now because there's no...
Welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling and compounding your wealth and life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more all over the way to help MVPs. My name is Brett Swarts. Each and every episode, we're joined by the world's top entrepreneurs, millionaires, or billionaires, and they share their secrets, insights, and wisdom with us so we can all level up and make a bigger impact. I'm excited about our next guest. He is out of the Gainesville, Florida area. And he's going to help us to permanently reduce our tax, or at least talk about some strategies to potentially do that today. And within 20 minutes, he can provide you with be able to identify a variety of solutions that maybe can significantly increase your profit and permanently reduce your tax. And he's going to share all this stuff with us right now. Please welcome to the show with me, Mark Myers. Mark, how are we doing?
I'm doing great, Brett. Thanks so much for having me. Appreciate it.
Absolutely. And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Sure. Actually, I started out at the University of Florida with exercise physiology and sports management. So a lot of people ask me, how in the world did you become a tax strategist? Well, after running really high-end health clubs in New York City and Los Angeles for a number of years, I realized I understand how to run a business, but I'm never going to make the money I want to make working for someone else, particularly in the fitness industry. So I left that space, became a consultant to business owners, specifically in the insurance space, which has a lot to do with tax efficiency. But I realized in the insurance space, there's a lot more to tax efficiency than just properly structured insurance. So I really don't even do insurance anymore. All we do is help people navigate the 75,000 pages of tax code to find what we call coupons, right? Because there's plenty of tax savings opportunities there. It's just that the IRS doesn't send out a flyer like Trader Joe's or whatever to tell you where your discounts are. So we really help people kind of navigate their fact pattern, look at coupons or tax incentives that they could use that are desired for them to use by the federal government. That's why they put them in place. And the net result can be, hey, you're keeping a lot more of what you work so hard to earn every year. So
Beautiful. So let's start with that. So what is maybe the number one secret or first step to helping anyone who's listening to permanently reduce their tax?
Sure. I'll jump past the novice and intermediate because a lot of people have heard, dwelling unit rental and Augusta rule and structuring an S corp so you can reduce your employment tax, all the things that people have heard before. And let's fast forward to a little bit more outside of the box, but inside the tax code thinking. One of the things that we like to do is we like to help people donate assets. So, anybody out there that's charitable minded, they know that when they donate to a qualified 501c3 or even a private foundation, they get a deduction, right? They get an itemized deduction on their Schedule A. And if their tax bracket, say in California, is 37% federal plus 13.3 state, they save 50 cents. So that's not a profitable endeavor, though. When you give $1 to your favorite charitable organization and it saves you 50 cents, your net worth is still less 50 cents, right? You gave away $1 to save 50 cents. How is that profitable? It's not. So that's where we come in. We say we have lots of relationships with owners of assets, non-cash assets, that they are willing to sell them for substantially less than the current appraised value. So that becomes interesting because if you can buy, for example, a $100,000 asset for $20,000, and then you donate that $100,000 asset, and you're in a high tax bracket, right? Say California. Well, that just saved you close to $50,000 in tax. But remember how much it costs you to buy the asset, $20,000. So the question is, do you want to send $50,000 of tax to the feds and the state, or do you want to buy an asset for $20,000, donate it, and save $50,000 in tax, netting you $30,000? So that's one strategy that we use over and over again that is pretty straightforward in the books. You do have to follow the rules. You have to own it for a year or have a way that you can own it for a year without physically owning it for a year, which all has to do with partnerships. And it has to be appraised by a third-party independent qualified appraiser. So those two things are really, really important to make sure your hold period is long enough or it meets the standard. You're actually donating it to a charity that will do good things with it. And you also have a very valid appraisal, right? Because that's going to be something that the IRS will probably want to look at if they audit your donation. They're going to look at, well, how did you get the valuation of what you donated? So that's a good one that we use all the time.
Okay, excellent. So yeah, the donation strategy to reduce tax, which sounds pretty straightforward. Excellent. What's the next one that's maybe outside the box but inside the tax code?
We really like helping people structure a fairly turnkey solar business. I think, Brett, you've probably heard a lot of people have done this for years, right? Real estate, it's a great way to build wealth and reduce taxes. Well, and it is. You buy the real estate, you leverage it. You get your depreciation. Maybe you do cost segregation. Maybe you buy short-term rentals so you can actively participate in that business up to 100 hours or more, which means that you can take the depreciation against your active income. So real estate is something that's kind of blazed the trail for this, but when the federal government, particularly, this has been for 20 years, but particularly in 2022, and even though the One Big Beautiful Bill kind of changes things a little bit, we still have a 5-year runway. But when the federal government said, we want the private sector to expand the renewable energy grid, particularly solar, well, that created a huge opportunity because now we can put people in a solar business. It's very easy. They're not rolling left and right at night thinking about their solar business and how to grow it. They're basically acquiring solar projects through their small single-member LLC solar business that we help them structure. And they're materially participating in that business to the point that the IRS requires, right? Just like if you want to be a real estate professional, it's 750 hours. But unfortunately for solar business, it's only 100 hours, right? And you don't have to do, more real estate or more solar than any other business, right? Because with real estate, you have to do more real estate than any other business that you work on. So it's really tough to hit that metric. So going back to the solar, well, the federal government will give you 30, 40, or a 50% tax credit. They don't do that when you buy a duplex or an apartment complex. They don't give you a 30, 40, or 50% tax credit. And a tax credit is $1 offset, right? If you have $1 tax credit, it's going to reduce your federal tax by $1. So it's way more powerful than depreciation. And here's the thing with depreciation. With a solar project, you can depreciate it 100% of it in the first year. without doing cost segregation or anything, because you have bonus depreciation. So you can get 50% tax credit plus 100% bonus depreciation plus 5 years, a 5-year state schedule of depreciation. So literally you can put $1 into your solar business and save more than $1 in tax pretty much in your first year. And oh, by the way, this solar project will produce positive cash flow for 30 or 40 years. So how about that? So that's another way that, and we can also generate enough excess tax credit to carry it back, because the solar tax credit will carry back up to 3 years.
Okay, let's break through that. I'll make sure I caught all that, and then we'll talk about the investment itself. So acquiring solar projects, start an LLC, and then let's say you put $1 million in it. Okay, and you're like, all right, I want to really make this thing rock and roll here. You only have to put 100 hours into it, and it doesn't mean you have to do more than. So real estate professional status, either your spouse, right, needs to basically be working with that and not doing anything else. And or you're putting more time. You're like, it's your profession. It really is your profession. Okay. So, but you don't have to do that with this one. You only have to do 100 hours, or your spouse does 100 hours. And then it's $1 tax credit, no depreciation cost seg, no cost seg required, study required. It's 100% depreciable in the first year. And you mentioned 30, 40, 50% tax credit. I'm not sure what that meant. Does that mean like if I put $1 million in, I'm going to get 500,000 or 400,000 or 300,000? Is that what you meant by that?
That's correct. That's correct.
Okay. And then you said 5 years. What's the 5-year thing? Walk us through that one more time.
So if you're in a state that doesn't abide by the federal kind of opportunity to bonus depreciate, then you're running a 5.5-year maker's schedule. So you're able to take that state depreciation over a 5.5 year.
Okay, what states don't participate? Do you know? Or the main ones?
Most of them. I would say most states will make you go makers. So you'll have to take that depreciation over a 5.5 year.
Okay, so it may not be. So even though, okay, so you meant to divide that. So if you got like, let's say 50%, so 500,000 on that million, you would have to divide that by 5 years. So it'd be 100,000 per year, $1 tax credit off your taxes.
Well, the tax credit can be taken all at 1 year.
Okay,
so
got it.
Depreciation has to carry over 5 years.
Okay.
You get tax credit and depreciation and cash flow. So.
Okay, so we'll talk about the tax credit for a second. So what is the exact tax credit if I put $1 million into the LLC? What would that be for year one?
So a lot of times what we do is help the client leverage. So if it's $1 million solar project, you might have put 600,000 in.
But let's assume we put it cash. We don't want to leverage. I just want to keep it real simple. Okay. So you put a full $1 million in. Am I getting a full $1 million of tax credit?
You're going to get up to 60%, but let's call it, most of our projects are 40 or 50%. So you're going to get a $500,000 tax credit.
Okay, so $500,000 tax credit. Okay, and that's just off of any tax that I have. It's just first year $500K. All right, so that's, in one sense, you can look at it as if I had a $500,000 tax bill, I just got a 50% return on my money, maybe, because I put $1 million in.
That's right.
Okay, and now this project's going to go for the next 30 years. Am I actually running the project, or like who's running the solar project?
So you are responsible for that solar project as an independent at-risk solar business owner. But the way you structure your project, it's collecting energy, right? It's collecting sun. It's got an inverter. And there's not a lot of work to do.
Okay.
The first year you do need to, make sure that you are doing enough oversight of that build out. Now remember, you're relying on contractors that we are helping guide you to.
Okay.
So you can hit that 100-hour mark. But of course, past the first year, depending on your situation, you may or may not need to do 100 hours because you've already got all your tax benefit.
Okay. So what is exactly the business now? So like, walk me through that. Like what is this? Like, what are they building? Are they building solar panels out in the field? Like, what does this look like?
It really depends. I mean, think about like if you're a real estate professional, you might buy a single family residence, you might buy a duplex, you might buy a fourplex, you might buy a small apartment complex. With solar, you may buy movable units. You might buy, say, pods that the roof of those pods are solar panels. And those pods basically compete with, Pack Rat and Pods, the business. But the pod that you own produces energy and actually provides a movable space for people to move their stuff from house to house. Or you might own panels on the roof of a storage facility or a hospital or a airport. So essentially you're going to own energy producing panels somewhere, whether they're carports, they're integrated into cool movable products, they're on top of hospitals. That's your business.
Okay. And then your experience is people are making what kind of cash on cash return on that million if they invest it?
Well, the way that we generally structure it is if they're putting $1 million in of cash, let's just say they take no financing.
Yeah.
They'll have $500,000, get $500,000 back in tax credit.
Yeah.
And they'll have a $750,000 depreciation that they can take in the very first year.
Okay.
Federal. So depending on their tax bracket, let's just say that saves them 40%. So they have $300,000, right? So they're almost in the black from the tax savings. And now because there's no note on that solar project, you're just looking at a 3% increase of the energy prices every year. So you're probably looking at maybe a 5% coupon, maybe 5-6% per year.
Okay.
3%.
Okay. $50,000-$60,000 per year. Got it. Okay. And then goes for, you said 30 years. Like who determines the lease rate or the term of that? How do we know that's going to be around for 30 years?
So the panels that we generally recommend people utilize are 40-year warranty, and they're U.S. made in South Carolina. It's one of our vendors. So they have a 40-year warranty, and we always help our clients set up structures. So when they're going into these structures, generally there's a initial 6-year and then a sequential 34-year lease to get you through the 40-year warranty period. So they really have the option of keeping these panels for 40 years, but they don't have to. Just like anything, you own a piece of real estate 7 or 8 years later, you don't want that. You don't want to hold that piece of real estate anymore. There's ways to exit. You can sell. There's other things that you can do in the solar business to exit.
Okay. All right. It's interesting. Yeah. And for me, I'm always like, who's making money in the solar industry? Obviously people are when they know what they're doing, but then are you partnering with those people who are already doing it, have already got it all set up, versus trying to do it yourself. And, so there's just kind of that piece of it there. But the tax stuff sounds really, really incentive. Okay, let's keep moving because we could probably go down that rabbit hole for a while. What other ones that come to mind, besides solar that you're like, hey, these are like some low hanging fruit?
Yeah, I think when people are selling appreciated assets, there's a couple of ways to tackle that, Brett. One would be prior to the sale, you can structure an entity and move those assets into the entity and then sell the assets from within that entity. Well, why would you do that? Well, if you're trying to remove constructive receipt, you're trying to remove assignment of income. So if you move the assets to another entity and you control that entity but you don't own it, well now, and it's sold in that entity and you structure that sale such that there's really no net profit for that entity, well now you've got all the cash from the sale in that entity and you can reinvest it. Now, of course, as you take money from that entity, you're going to have to pay taxes on it, but it's better to sip the tax over time than gurgle it all at one time, depending on the situation. Or option 2 is they reach out to us and they say, well, I heard you could help us with long-term capital gains tax. We just sold our business or a piece of real estate or a piece of land, and we had this huge income event. And I say, great, when do you, or they say, we had it. And I'm like, oh, how? So you sold this year? Yes. Okay, well, we have until the end of the year to help you offset. Now, that could be with solar. That could be with a donation. It depends on the charitable. It depends on their state and how much tax they're going to pay. Or it could be, well, let's look at a partnership opportunity that you can put capital contribution into, and that partnership will disproportionately provide you a loss. So if you get into the partnership, you might be able to actually capital contribute into a partnership for, say, a couple $100,000 or $150,000, and they will generate a $1 million negative K1 for you. So, for example, if you had $1 million of capital gain and you got into this partnership and you spent $150,000 to get into the partnership, and they were able to disproportionately appropriate a $1 million negative K1 to you, what just went away? Your $1 million long-term capital gain or short-term capital gain. And it went away for $150,000 because that was the cost for you to get into the partnership. So now you are, this is a trading partnership. So the master partnership does their trading, you do your trading, and of course every single year you net it out. You're going to pay taxes on your income from your trading. And as long as you stay in that partnership, you're not going to get your positive K1 back, because essentially when you exit the partnership, you're going to get a positive K1 for the same amount that you got the negative K1 when you join the partnership. So it's a pretty unique opportunity if you get caught. And I say if you get caught, get caught not planning your exit prior to sale. We always say it's better to plan your exit prior to sale so you know how to handle your tax bill before you sell it. But if after you sell it, we need to use solar, or we need to use charitable donation, or we need to use like a strategic partnership opportunity for you, we can do it, and it helps you to offset the income that the tax you're paying on the income.
Excellent. Let's talk about the first part of it. Yeah. So I think what you're referring to is like an installment sale or like a deferred sales trust, where people are selling to a trust in exchange for a promissory note. Then the trust sells it to the buyer, and then the funds hit the trust, and the trust just plays out slowly. Is that what you're referring to on that first piece of it?
If you want to go with a more simple approach, yes. If you want to go with a more sophisticated approach, we generally utilize estate planning and private placement life insurance. So
Okay.
the tax efficiency is actually greater than a deferred sales trust.
Okay.
And it also gives you a lot of estate tax. I mean, the focus is really estate tax, but it gives you a lot of income tax planning. And that would be for larger income events, say 10 million or more. But to that point, yes, we're really shifting assets into another structure. Because you're not taking assignment of income, there's a different tax treatment on that structure. And then it's about how do you get money out of that structure in a more tax efficient way than whether you just sold it under your own name.
Yeah, that makes sense. I'm curious on the private placed life insurance, the ability to invest back into real estate or other businesses, or does it put you, is there restrictions on how and where you can invest the funds when it's in this private placement life insurance estate planning plan, or is it really flexible? You can kind of go invest into different things whenever you want.
Yeah, it's super flexible, Brett, and this is a really great question because a lot of people want to have flexibility with their investments. And this PPLI is unique in that it's COLI. So it's company-owned life insurance, so there's no underwriting. I mean, the underwriting can be done in literally a week, and the insured, like the client that owns the policy, the client that owns the policy is not the insured. So a lot of times, the policy is, the insureds are maybe 1,000 teachers in a union, right? That basically wanted their pension to be more reinforced by this insurance policy. So the great thing is now your client has this insurance dedicated fund that wraps around whatever account they have, and they can use it to invest in any asset class. Now, of course, with PPLI, there has to be a balance, right? There has to be at least 5 asset classes, and they can't be significantly unbalanced. But to that point, real estate, cryptocurrency, digital currency, stocks, bonds, private placements, anything they want to invest in is fine.
Excellent. Let's do 2 examples of that. So you had a $10 million exit. You have 0 basis. You're in California, no debt, no basis. It's a business sale, and you're setting this up, and then you have $100 million. Same concept. We'll do real estate on that one. So I'm gonna pay $3.7 million, 37% state, federal, Obamacare, in California. So all 10 million goes into this PPLI, and then what? How much do I get paid back when? And then how much of it's going towards the life insurance? Walk me through a little bit of what that looks like.
Sure. Yeah, this is getting a little bit into the weeds, but we'll keep it as high as we can because it's really custom. It depends on the person. It depends on what they need, what their estate planning needs are. Obviously, the dollars that go in, sometimes we'll use the exemption to reduce their estate tax. The great news is any growth that happens within this trust structure is frozen, so none of the growth on these dollars go towards their taxable estate. So we're always kind of looking at how that structure. We might create slats, to essentially initially fund their PPLI. But what happens is all the assets that they're going to sell, or some of them, like say it's a $10 million sale and they don't want to put all $10 million into the structure. Say they want to put $8 million. But let's just go, they can. But let's just say they do want to go ahead and shift everything over there. So now they have $10 million in their estate planning trust. And that estate planning trust was already structured previously with the PPLI. That estate planning trust, the PPLI has the opportunity to withdraw. It kind of has like 100% crummy power. So at any point in time, the person that contributed those assets into that estate planning trust, they can actually have their PPLI withdraw from that estate planning trust. And once it withdraws, the PPLI is a tax exempt structure. So whatever they pull down from that estate planning trust is in the PPLI. And while it's being invested there, there's no taxes on the gains, and there's also no taxes if you take a loan from your PPLI. So essentially, it's how much do you want to use that PPLI during your investment life cycle? But as you're using that PPLI, you have a lot of tax efficiency there, because you can actually move money out of that taxable estate planning trust environment. Because if you take money from that trust, because you can invest money in the trust, but when you take money out of that trust, you're going to be paying tax, kind of like a deferred sales trust. But when you drop dollars into the PPLI, so long as you follow all the rules, well, you can grow that money tax deferred, and then you can take loans against that policy tax free.
Interesting. So you said the cost out the refi or the take a loan against the PPLI. Is that for businesses or personal use, and it's not constructive receipt? It's not taxable if you do the loan?
It wouldn't be taxable because the way that this estate plan is set up, you have settlers. You're not controlling the income. I mean, you don't own assets, but you control them. Once they drop into the PPLI, there's a different kind of application of how you're, accessing those dollars, because they are loan dollars. They wouldn't be considered taxable to the owner. So it's, again, this is a very very sophisticated structure that is for larger sales, but it does provide a substantial amount of asset protection, estate planning, particularly with the freeze. And if the PPLI is used correctly, there can be a lot of income tax planning as well.
One of the big questions I think listeners will have is like the audits. So how many of these have been done? The legal team that set them up, have they been through audits? What was the outcome of the audits? How long is the track record? So for that, because that would be pretty awesome if you could do what you just said and take loans against it and basically do whatever you want, right? And you still have this big life insurance payout at your death, and defer all the tax and eliminate the estate tax and get asset protection. And that would be really pretty powerful. So do you have the audit? Like how many audits have been done, and then how many have closed over what period of time?
So because this structure is highly custom, we're looking at probably the last 5 years of implementation. Not that many per year, maybe a dozen. This is not something that's like syndicated at all. Mm-hmm. And there's been no audits. Okay. So, but there is an audit plan in place. They're ready if they ever need. They actually have a litigation attorney that would, take it all the way to the end that needs to go there.
Fair enough. This is good. Thank you for jumping in the weeds with me on that. I think the 1031 exchange gets too much hype, and people need different alternative strategies, and they need a chance to get true diversification, true liquidity, and the ability to navigate large exits. And also for public stock, I know there's a strategy that we use that eliminates the estate tax for public stock, and it can be $1 billion exit without any charity, life insurance, or gifting required. Goes back close to 30 years, thousands plus transactions within this law firm that's defended against the IRS. So I love hearing new ideas, Mark, but my caution is, 5 years, no audit track record yet. And I'm sure, these guys can do it, but I wouldn't want to be the guy who's like, okay, I'm selling the $100 million deal and no audits have happened. I'd be very cautious to just jump in with one that hasn't been through at least some of the fire, right? Because that, to me, that's the foundation of a lot of these things. Any other thoughts on that? But maybe I'm missing something.
No, I think that it's all about what the risk profile of the person that's actually entering into the transaction. Mm-hmm. And it may provide a lot of benefit to them over some of the alternative strategies. So they're willing to take some or all of their equity and put it into the structure. So a lot of times, Brett, that being said, maybe you don't, it's a $100 million sale. Maybe you only move $20 million into the structure. Mm-hmm. But to diversify your risk. But to that point, yes, I think it doesn't have the years and years and years of
Yeah.
yeah.
Yeah. Well, and I hope it does. And I hope it keeps going. I hope it gets the audits and it passes them. And that would be really cool because that sounds like an amazing strategy. Keep going here. Any other strategies or thoughts that you want to add before we go to the lightning round?
Those are our main. I mean, there's a lot of things out there, Brett. But we want to go like when it goes to scale of 1 to 10, 10 being like fairly aggressive, like the maximum aggressiveness with regard to how you reduce your taxes. 0 and 1 being like, hey, I'm just doing a mortgage interest deduction, right? Like there's nothing wrong with that, or I'm funding my IRA, give me a break. We like to stay 5 and under. So a lot of the things that we could talk about today, what I think are over the 5 scale. So like solar, charitable donations of a non-cash kind, following all the rules, a trust planning prior to the sale. We've, even though this is not something that's been around for 30 years that has tons of audits with this estate planning, it's done, if you look at the tax code application, it's like right there in the law. Obviously the question is, would they try to call step transaction? And I think that not. But, the partnership where you're purchasing the negative K1, that has been around for 30 years. They have defended audits. And they've always come out no tax due, no change in plan. But I will say this with a caveat. Whenever anything goes into more of a syndicated fashion, I can tell you that the IRS is going to pique their interest. We know what happened with conservation easements, right? They're still fine. You can still do them, right? But Senate had to help the IRS out and pass a law that said if you do a syndicated conservation easement, you can only get a 2.5 multiple. Why? Because they couldn't stop it. So they had to get Senate to give them a haircut. So just keep in mind.
Same thing with monetized installment sales, right? I mean, they were like, hey, here's 93% of the funds up front. Basically do whatever you want with it. We'll call it a loan. It was a faux loan. We'll call it 453, but you have all constructive receipt and they can go spend it whatever they want. And they call it a 30-year loan. And they're like, guys, like the essence of 453 is truly a loan. And the essence of constructive receipt is when you have it personally to do in your own account. So how can you have both, right? And so you should be paying tax as you receive it. And we have a competing structure, and so we would go up against it, and we're like, guys, like we only lost a couple to them, but we're like, hey, let us know when you pass the audit or what happens, and then it, it's now on the dirty dozen list and the IRS watch list and all the things, and I'm like, we're like, that's the point, right? But you got to be careful. So that being said, we're way out of time. Are you ready for the lightning round?
I'm ready.
All right, knowing what you know now, if you go back to your 20-year-old self, what's the one golden nugget? Make sure you tell yourself to do.
20 years old, going back. Take every dollar that you earn and tuck 20% into savings.
Excellent. Question number 2, number 1 book you've recommended the most the past year?
The Bible.
Excellent. Question number 3, what are you most curious about right now?
Passive income.
Question number 4, what's the number 1 way you're using AI?
Right now, it's for expediting our blueprint creation as far as like running analysis, and also providing an AI bot for our clients. So when they're due diligencing our structures, they can go in and we can give them 30 different documents, or they can use an AI bot, ask the question, and it'll find the answer for them within the 30 documents and point to where they are.
Beautiful. Top leadership quote or theme that you strive to live by?
That's a good one. Henry Ford, he's, whether you think you can or you think you can't, you're generally going to be right.
Yeah. Good. Love that one. Very last question, Mark, and I'll wrap it up. After all your helping all the people you've helped over all the years, what's the number 1 way you best keep a mindset of stewardship over ownership?
I think stewardship over ownership is really important. The mindset is, as you mentioned, it's how do you it's like an evergreen process. So if you're stewarding something, it's always a cyclical. So if you keep that cyclical mindset, how many people can you continue to help, including yourself? I think that's ideal. Stewardship over ownership.
Awesome. Mark Myers, it's been more than a pleasure having you on the show. For our listeners who want to get in touch with you, one last time, what's the best place for them to find you?
TaxWisePartners.com. And we have a link there that they can actually book a 20-minute consultation, no cost, just to figure out if something that we have in our toolbox would work for them.
Amazing. Thank you, Mark. I also want to thank all of our listeners and viewers for watching listening to another episode of the Build to Billions podcast. And we're also streaming on Capital Gains Tax Solutions podcast and YouTube channels. And we're on this mission with you on this journey to scale from millions to billions so we can give more all the way to help MVPs, the most vulnerable people. I'm Brett Swarts. I appreciate you listening and watching out there, and we'll talk to you all real soon. Bye now.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.